The U.S. tax code wants you to be well off in retirement. My name is Paul Vasquez with Tax Lab. At Tax Lab, we help you become an ethical millionaire. We do this by using the rules of the U.S. tax code. The U.S. tax code has been fought over for 200 years. For over 200 years, we've had income tax, and in that time, the Congress wants to bring in revenue from our earned income, and individuals have said, don't take all of our income. And so they've fought over those rules for years. And because of that, most likely inadvertently, they've etched into the rules of the tax code a pathway to wealth in America. And this is what the tax code says you should do. You should save for retirement. Now, this sounds like something that, of course, you've heard this 1,000 times before, but the U.S. tax code wants you to do it. They incentivize you to do it. If you don't do it, you pay more. The U.S. tax code has in it retirement programs that say if you put money in here, we won't tax you on it. That's right. If you follow the rules, you can put money into these programs and never be taxed on those gains from that investment again. Zero taxes. Zero taxes. It says right there that if you're smart and you save for retirement and follow some simple rules that basically mean you're going to use this money in retirement, that money is tax-free from then on. Now, the limitations they put in place are designed to make sure that you use that money in retirement, meaning that if you don't, you're going to get penalized. It's a carrot and a stick approach. If you do the smart thing within the rules and we mark it that way, we say, hey, this is the retirement money and we have all the right paperwork in place, that money is tax-free. So if we can get all of our money into these special accounts that are designated, that the IRS says, hey, this money is going to be managed, it's going to be managed this way when it comes to withdrawals and things like that, you get it. All the earnings that are sitting there in that account, we can put that account to work in the stock market, in real estate, in other businesses. You can have that money work for you. And it's the smart thing to do. You know it is. You don't want to live paycheck to paycheck for your whole entire life. It's up to you to do the smart thing now to help take care of the old you. The tax code wants you to do this. It's incentivizing you. It says, if you do the smart thing, we won't pay you, we won't charge you taxes. If you do the dumb thing, you get penalized. We charge you more in taxes. You can see how it's right there. Carrot and a stick approach to say this is the smart thing to do. This is how you do it. It's right there in the tax code, and it's become more and more available. It's been there for the wealthy for years. Yes, we know that. But now these things are available to you as well. Mostly it's technology. Technology now allows your Schwabs, your TD Ameritrades, Robinhood, these companies now will let you have these accounts for free. These special, what they call individual retirement accounts, IRA. That's what it stands for, individual retirement accounts, IRA. And there's two types of IRAs, individual retirement accounts. There's special accounts designated. If you put it into that wallet, that jar, that bank account specifically, that's got all the right paperwork. You get reports on it every year. You report it on the taxes, but the main reason you're reporting it on the taxes is that way you're saying, this is the money that you've agreed not to tax me on. I'm doing the smart thing. I'm doing the smart thing. And because you've got all the paperwork lined up saying you're doing the smart thing, you're not going to pay taxes on that money ever again. Now, there's two types of accounts. There's one that is tax me before I put money into the account, or tax me later when I take the money out. So where you're getting the zero taxes on the growth, right? So normally you're going to get taxed on any income that you have. And they're saying, hey, you can either get taxed on it now and then invest it, and the investment will get zero taxes on it, right? If you listened to my last one, we talked about how you can get zero up to $47,000 if you're single, right? Get it into there. If you've got total income is under $40,000, all the long-term capital gains, zero. Now, what if you have more than $40,000? What if we go over that $47,000 limit? How can we still maintain 0% tax? This is how we still maintain 0% tax on that growth. It's telling you the formula right there. Anything over that amount. So first, if you listened to yesterday, you want to get as much income off of the out of earned income and into unearned income or long-term capital gains. If you're single, that's $47,000 and a little bit more. You know, they change it every year because of inflation. So they're working with you. They are working with you. And then if we feel like we need to go over that, it's time to go over that. Let's be smart. Let's put more away for when you're older, because when you're older, you're going to have additional medical expenses and other things, and we can talk more about how to even maximize even more when it comes to all these things. But we got to start with the simple steps. Okay? First, start saving. If you are not good at saving money, it's because most likely all your money is accessible in one place. You need to give yourself a little bit of a roadblock to accessing money, to make you at least take a minute to think and say, is it worth me going to the other bank account? So if you're having a problem starting off, do this. Open up a savings account or a checking account, most likely a checking account. Don't bother with the savings account because you're getting so little interest that it's going to cost you more to process the tax information related to that small savings account. If you're not earning more than $20 a year in that savings account, it's going to cost you more in processing the taxes than anything else. Just a checking account in a credit union or local bank. You have your regular paycheck deposited into a larger bank that you can access if you're out of town, that has multiple branches, and has a larger footprint. All right, that way, when you're out and about on vacation, you can access that. But then you have that separate small business or small local credit union or small local bank, and you don't keep the debit card and credit card on you for that account. You hide that away somewhere, so that way you have to go dig it out if you want to use it, or you have to go down to that branch. You have a little bit of a roadblock in place, and then every paycheck you just deposit what you need to in there, even if you have to take it out the next day to pay your bills. But you need to establish the habit. Establish that habit, get it so that way now you've got, once you get around $5,000 to $10,000 in saved up, now we can start investing that money. And once again, if our income levels are there, the long-term capital gains tax-free. Even before you get to that point, let's start putting away for long-term capital, long-term 0%, right? This is how we maintain 0% taxes. I've got more to tell you guys, but you need a plan designed just for you. Go to lab.tax, click on advisory services, get your free 15-minute consult.